Greetings. Hey, everybody. We are privileged to have an outstanding panel joining us today at a time that is as consequential as any we have known, not only in our professional lives, but for our entire lives, no matter what age each of us may be. One of the features of this pandemic is that after a pause in the springtime, many aspects of white-collar life have returned, somewhat astoundingly, to a readjusted new normal where things get done nearly as effectively as they did pre-pandemic. This new normal is evidenced on the one hand by Zoom calls substituting for trade shows. And on the other hand, we see transaction activity in the self-storage sector not only restarting, but increasing to levels that would have been unthinkable just a few short months ago. Self-storage in particular is emerging in our new pandemic normal as a standout in the real estate investment sector, further solidifying its position as a recession-resistant, consistent performer, and in many senses a darling of the real estate investment community. With these extraordinary times as the backdrop, we have an outstanding panel today to discuss the current self-storage transaction market. Jessica? Okay, well, we were going to have some bios, but we don't. So why don't each of you introduce yourself for 15 seconds, and we'll take it from there. Starting with Marc.
Thank you, David. My name is Marc Boorstein. I'm with MJ Partners Real Estate Services. We're based in Chicago. We are involved with transactions nationwide. I'm a second-generation self-storage practitioner, been involved in the business over 30 years, with MJ Partners over 25 years. And we've been involved with over $2 billion of transactions. We're involved in consulting basis as well as transactions, working with new private equity developers, lenders, REITs as well, helping them put together portfolios and then ultimately transact them in terms of dispositions. David, you touched on it, something that has turned so quickly that it's really amazing. And we're using some of our past experience for previous recessions and other new forms of capital coming to the industry now, comparing it to the past few cycles. With that, I'll let someone else continue.
Okay, Shawn, take it away.
Hi, my name is Shawn Hill. I'm a principal and founding member of the BSC Group, also based in Chicago. We are a mortgage banking and financial advisory services company that specializes in self-storage. So I think unlike a lot of financial advisors that are generalists, we have been working the self-storage industry for over 15 years and try to bring a high degree of knowledge in that sector, specifically to lenders in the space, lenders and our clients.
Thank you. Mike?
Good morning, everyone. Mike Rogers, Life Storage. Life Storage is a real estate investment trust. We own 600 plus locations in 28 states, I believe, and we are a manager, partial owner in JV locations in 300 plus additional locations around the country and recently into Canada.
Excellent. And Ben, tell us a little bit about SROA and yourself.
Great. Thank you. Thanks for having me today. Ben Macfarland, CEO, co-founder of SROA. We operate our brand under the brand Storage Rentals of America. We are focused on primarily secondary, tertiary, and some primary market opportunities. We look for cash flowing assets. Primarily self-storage is our main focus. We're vertically integrated and we're based in West Palm Beach. We've got about 8 million rentable feet today and actually growing through a fund model where we raise capital through discretionary funds, fund, and we're currently raising funds to our dedicated self-storage fund.
Okay. So before we get started, everybody, I want to ask a special request. We're limited to 45 minutes today, some of which is already ticked off. I kind of like to treat this whole thing like a lightning round, in that I think the more of us that speak on more topics, the better received this panel will be. And if there's a need for further detail, we can jump into it. But let's go quick, and we'll see what questions pop up along the way as well. So to start, I'd like to ask each of the panelists to address this question. What do you think is driving the recent spike in self-storage transaction volume? Post-lockdown pent-up demand, potential changes in the capital gains rate, other factors? Again, Marc, starting with you.
Okay, I'll start with, I think there's two main reasons. Number one, the fundamentals have held up so well during this pandemic, similar to the last recession as well. So the recession-resistant nature has been highlighted, and the rotation of capital from commercial real estate, different product types into self-storage certainly has helped that. Number two is the low interest rate costs, both in fundraising, bonds, as well as equity and cheap, relatively inexpensive acquisition debt has helped fuel that. So the combination of new capital going in based on fundamentals and low interest rate costs are fueling the boom in transactions since the last couple months during the pandemic.
Okay, so that was a great macro answer. For a micro company-specific answer, Ben, why don't you take a shot at that?
I think it's primarily pent-up demand from the last 7 months. A lot of transactions got put on hold. And I think there's, an ongoing wave of consistent exiting from this asset class from smaller groups, families specifically, that don't have keep planning in place. And so if you have a mousetrap that can swallow it, you're beneficiary of this. And I think that's a big portion of it. Recent spike is a little, I've had a couple calls that have led to transactions around cap gains, but I think those people already were thinking about selling, and it just pushed them over the edge. I think it's really pent up demand. You just lost, a good portion of our year.
Okay. Mike, from the public company perspective?
Sure. I think we're seeing a little bit maybe supply driven and demand driven on the supply side. A little bit, I think, on the year end transactions with regard to some tax code concerns that might be driving sellers to bring to market at this point in time. But also, we've had a little bit of some owners harvesting, maybe looking to bail out some other distressed asset classes to sort of compensate for some failings taking place in those sectors. On the demand side, we are, no question, seeing traditional REIT and PE players buying, but we're also, I think, experiencing capital fleeing out of some other stressed asset classes coming in, looking to acquire, looking to get in. We've seen at least one notable transaction from PE this past quarter. So, it's definitely happened.
And Shawn?
Well, it's not going to be very fun if I have to go last every time because everybody's already said everything. But I think that certainly, these guys hit on it. Where it's appetite for product, right? There's investors across the CRE spectrum that are looking for yield, and they're certainly not going to do that or obtain that in retail right now. That would be a big risk. I think hospitality is struggling. I think, you have various CRE asset types that are not looking very favorable right now. And I think you've got incredibly cheap debt. So you've got a lot of institutional sponsors that have been looking to come into self-storage already who are now coming into the sector because they have a lack of alternatives. So I think that's definitely a driving factor.
Okay. Shawn, I cannot manage your hurt feelings about being last, but I can ask you the next question first, just to give you a clear shot at the playing field. Now that the secret is out and all sorts of capital is rushing into our sector more than at any other time, where do you see the greatest opportunities for future profitability and yield within our sector?
I think that it's really going to come down to creativity across the capital stack. I think it's going to be in the area of structured finance. So, I think you're already seeing that, right? You just saw with the Next Point acquisition of JCap, you saw Extra Space do a $300 million preferred equity investment into the space. And, $300 million is incredibly difficult to deploy right now in the self-storage sector. And so if you look at the strategy behind that, they bought management on 37 stores. They have a future management pipeline, and they feel like that's probably I'm not speaking for them, I'm guessing they feel like that's a pretty safe place to park their money and generate a nice return rather than have to slug it out. I think you can also look at Blackstone's acquisition of Simply. Same thing. It's very difficult to deploy that kind of capital. Not only do they buy the assets, but they bought the operating company. And Blackstone is a master of using structured finance to grow their empire. I think you're going to see, joint venture recaps, potentially partnerships with other large players in other CRE segments. I could definitely see a situation where potentially a retailer or a mall operator would partner with either, a PE fund or an operator or a three-way joint venture. I think it's going to come down to creativity. And I think that for the smaller operators, there's an incredible opportunity right now to refinance existing assets that they have a lot of equity in at incredibly low rates. Rates in the 3% range with extended interest only periods can really increase your cash flow over the next decade. So I think it comes down to using the capital stack and getting creative and figuring out how to generate returns.
Speaking of which, Mike and Ben, from the public and private company perspectives, what lending structures are you finding to be most advantageous as we come out of the lockdown periods and transaction volume has stepped up and different lenders are taking different postures towards their reemergence in the market? Why don't we start with Ben from a private company perspective?
Well, I'd like to just let out all the lenders know, if anyone's on, if they'll take out the floors, it would be really helpful. I feel like I'm not getting the benefit that the government's offering all of them. So if they could really just help us out there a little bit. But I'm spending most of my time with life companies right now. Balance sheet lenders, getting things in there that you can't get out of any other sort of lender, especially CMBS and anything that's unreasonable around structure. But getting the last 2 years open, getting more IO than I normally would have gotten out of life companies. I think there's been some benefits to it, and it's competitive with rate. So that's where I'm spending most of my time.
Have they stepped up on LTV? That always was a major constraint with life companies.
Yeah, we're seeing in the 65% range. I don't really go higher than that anyways. So, it's, I'm typically a 55 to 60% loan value. I think, it's a good place to be in self-storage. My entire portfolio is at about 53% on average. So that's a relatively low level portfolio.
It sounds like a great match with life companies.
Yeah.
Mike, I know that you have access to all sorts of capital, and how are you picking and choosing these days?
Right. So, being public, we're somewhat fortunate. We get to avoid, whenever we're buying into the REIT, we don't need to sort of go deal by deal, loan by loan, canvassing lenders. So in that regard, we're fortunate because we can just dip into our credit line and deal with some broader type of financing. But we do stay involved quite a bit with JV partners, and whenever we do acquire or develop with the JV partner, of course, that we do dip into the lending market, and we typically don't like to see any recourse sort of coming back to the REIT. It's just too easy to sort of put the clause into the, and have a REIT backstop. So in that regard, we'll maybe look to sort of seek LTVs at lower levels, so we don't have to, really have that sort of activity. But there's no doubt there's a lot of variance out there right now, and there is a lot of competitive terms. We typically like to see a broad base or a broad matrix of terms. Quite often we will engage a firm like BSC to sort of canvas that for us. We think that is to the advantage of the borrower, just to sort of see what's out there. Get a broad base, going in, if a mortgage broker is involved, that they can really kind of step right out of the gates with the best terms available.
Okay, excellent. I'm going to jump around a bit here. Marc, we all see what's happening as 2020 is coming to a close with a spike in transaction volume. What are your expectations for the self-storage transaction market as we enter 2021?
As long as the interest rates continue to be this low, we anticipate the transaction volume continue to be very elevated. We think there have been some smaller operators that we've been involved with who want to take advantage of getting transactions done before the end of the year, take advantage of potentially lower capital gain rates this year than potentially next year. But we really think more importantly, it's being driven by the low cap rates that are being paid. For instance, let me give you a quick example. Brookfield, the CEO of Brookfield, Bruce Flatt, who runs the entire organization, they have the Simply Self-Storage portfolio under contract for somewhere in the low 4 cap range. His comments, the best assets, not necessarily self-storage in general, in the best markets, he would not be surprised to see cap rates to go to 2.5%. And that's not necessarily for self-storage, but the best of the best. So when you start seeing those kind of low cap rates, it's going to get the attention of the smaller operators with small and medium-sized portfolios. So we anticipate those transactions to continue with the portfolio premium widening in 2021.
Do any of the other three panelists have observations about what may be unfolding in the coming months as we enter 2021? Okay. Shawn, you have a diverse clientele within the sector, from public companies such as Life Storage, as Mike just indicated, all the way down to people with a single facility. Are you seeing a migration to secondary and tertiary markets amongst your clientele, in part driven by the pricing in major metros, which is really sky high at the moment?
Well, I don't know that I would say it's a recent migration. Certainly over the last couple of years, we've seen a redefinition of secondary markets, right? There was a time not too long ago when Wall Street was telling the REITs to get out of the secondary markets and focus on the primary markets. And as they sort of absorbed all the product that was available in those markets and needed to continue to grow, you've seen them now start to reach back into the markets that they retreated from not too long ago. And I think that there are certainly some smart people like Ben's group and other groups that have identified that trend early and have gotten out in front and have been, really it's now reaching from secondary to tertiary. One of the issues with the truly tertiary deals is you do start to have a limited pool of lenders. There are definitely larger, more sophisticated lenders that have demographic and other profiles that will preclude them from going into certain markets. And I would point to an example. We recently worked on a 4-property portfolio that was out in the market in Wilmington, North Carolina. And Wilmington was a market that's, a lot of lenders struggled with. So these properties were extremely competitively bid. There was a ton of interest in the deals. To get to, full proceeds, the cap rate was so low. And I think that's something that's interesting. We have sort of this weird situation when you're looking at underwriting a deal where you reach full leverage at a much lower point than would traditionally be considered full leverage. So when you're looking at a deal that's an 8 debt yield at a 63% LTV because it's being bid so competitively, you end up with it's not the easiest debt assignment to go place and meet the expectations of what the client needs to win that deal relative to maybe some more sophisticated institutional people that are dealing with a lower cost of capital. But, so I don't think it's necessarily a new trend, but I do think that it's a trend that we're going to see continue.
Mm-hmm. Marc, you have a national practice. What are you seeing with regard to major metros versus secondary and tertiary?
Well, it's interesting because the secondary and the tertiary valuations have, let's just talk about simplistically cap rate, have gone down lower quicker than the major metropolitan areas. They're not at the same cap rates as the major metropolitan areas, but they certainly have had a reduction in cap rates much quicker. And we're seeing more of the private capital go into these secondary, even tertiary markets, a little bit more so than the REITs. Maybe Mike can answer that a little bit closer, but we're seeing more bidding on the secondary and tertiary markets, very aggressive bidding from private capital, ones that may have not looked at those markets previously, but it's clearly a focus right now.
Yeah, I would agree with that. We've played in the secondaries forever, and as Shawn said, there was a time when analysts and maybe investors were kind of flagging, that the bigger operators should stay clear of that, because I guess the main difference really is rate per foot and what you can grab in the larger markets versus the smaller markets, and maybe the propensity to push rates is a little stronger and more available to do in the larger markets versus the smaller. But right now, some of our best performing markets are in the smaller markets, and we're there, we're staying there, and we will continue to buy there where it is feasible for us.
If I can put on my owner-operator hat for a moment, when we were investing heavily in secondary and tertiary markets, advantages included that at the time, you weren't really going up against the REITs. And so from a advertising and marketing perspective, you had what could be an advantage versus trying to operate in the major metros. And generally speaking, there was more room for improvement of performance because you could encounter a lot of situations that properties were significantly undermanaged and suffered from a lot of physical, deferred maintenance. Ben, is that what you're finding when you're shopping, portfolio shopping? What are you finding in the secondary and tertiary markets?
There's a couple of places we look for, real return to drive yield. The first is deals that we can find that are owned that we can get around replacement costs, that haven't spent the money on, they're capital constrained. The family literally has to reach into their pocket to make changes and bring things up to speed. Second is operationally, they're still working off of fax machines or, literally, taking handwritten ledgers and using QuickBooks as their primary focus for financial, purposes. And so, those kind of deals attract me to secondary, tertiary, any market really I'll go to if I feel like there's just a lot of meat on the bone from an operational perspective. And then the way that I'm able to transact in markets that maybe looked at as secondary and not primary, but still what I would consider strong, more plus style markets within inside the U.S., like a Northeast portfolio, is our ability to keep construction in-house. My first facility I did was in 2006. I converted an industrial property well located to climate control. And so I've always kept that part of my sort of culture here at SROA. And so, I think we have 12 different projects going right now that are all just expansions or additions to various properties. And I'll underwrite that knowing the risk factors up front and be able to maybe squeak out through some more value that others can't do, because it doesn't move the needle for them, where it moves the needle for us in the way that we operate and run our portfolios. So, and at the end of the day, we're an asset aggregator and looking to grow with scale, and scale is how you drive your return. That's on the expense side, and then the other places to find ancillary ways to drive revenue to top line, and which you can get down directly to the bottom line, and expansions and tenant insurance plans and all the different ancillary services that we have in our space. If you're not a great operator or able to implement them, it gets tougher to compete with groups like Mike's. And so it's really about finding those right opportunities.
Terrific. I'd like to break for a moment and just invite our audience to submit questions in the chat, and they will be in turn forwarded to us, and we'll try and take the questions towards the end here. What I'd like to do now is change the topic and talk about development. To kick off the development discussion, I think that if we had had this conversation several months ago, we would have said that the pandemic pretty much stopped this development cycle in its tracks. However, we've all seen what's happened in general in the self-storage transaction market. So I'd like your observations about where we are and what's going on in the development market, specifically as it's impacted by the pandemic and the disruption, and then the resumption of transactions in our sector. Shawn, why don't you start?
Well, I definitely think that there still on the lending side are some challenges for new development. There are a lot of markets around the country that are saturated. We've never had as much data available to the lending community as there is currently. And, let's not kid ourselves. The banks are not out of the woods yet with respect to the pandemic. They haven't passed the second round of any sort of relief bill. The lenders have a lot of uncertainty in terms of what is coming at them in their portfolios. And so I don't think it's as, I think there's a number of challenges. So I'm not sitting here telling you that you can't go get a development loan. But what I'm telling you is, it's certainly going to need to be a well-conceived project. It's going to need to have real sponsorship, deep-pocketed financial sponsors, and a track record of experience. And, I think that from that perspective, we're a little bit capital constrained. The lending community right now is a haves and have-nots world for sure. Good deals with cash flow, you can get incredibly aggressive, low interest rate deals on. Conversely, bridge deals that are stuck in the mud, deals that have been recently constructed by in the last 3 or 4 years that have been slow to lease up, or the more common story is they've leased up incredibly well at a fraction of the rents that are needed to make the deal viable. Those projects remain challenging to place in the debt markets. Unfortunately, there's a lot of capital chasing deals, and self-storage is, very, very well regarded right now. It is really a favored son. It's one of the cool kids. So if you're going to be able to convince a lender, I have a lot of conversations with lenders that start out with, well, you're certainly in the right product type, but there still are challenges in terms of development capital from my perspective on the lending side.
Marc, what are you seeing?
We represent about 20 to 25 active merchant builders, and these are groups that have been in the industry nationwide. And pre-pandemic, let's say they would be averaging, they wanted to build 10 to 15 projects. All of them, every single one of them, except for maybe a handful, maybe 2 that are in trouble, continue to want to build. So instead of doing 10 or 15, maybe they're doing 2 or 3 or 4 or 5. But the restriction is really on the construction lending. if they can get the construction loan, they're going forward with a number of these projects. They're just stalled right now. We can tell you some of the groups are out of the acquisition game, so they're going to continue to build merchant building. When I say merchant buildings, their plans are to sell them eventually, not upon C of O or early lease up, but some point along the lease up where they think it's the best time to do it. There are a number of transactions out there now that we thought we would have to offer next year that are being offered now because they're in lease up and there's so much capital they're going to be able to be taken out. So it's emboldening them to continue with their pipeline of development. Certainly less than before, but it's not zero anymore.
Mike, what's Life Storage's perspective on development these days?
Right. So I think globally, nationally, we think that deliveries of new supply were already peaking or had peaked. Coming into the year, we were fairly certain that COVID suspended real activity on permitting projects in construction for several months. We think that's sort of loosened up a bit now, heading into the third and fourth quarter. But, for the reasons that Marc and Shawn referenced regarding financing, and I think Shawn hit it on the head. They're going to require experienced developers, sponsorship, deep pockets. So all of those requirements, which I think should be in place, are going to put some of these developers seeking to kind of get in and get out quickly. It's going to put those guys to the side. And so I do believe that for all these reasons that, deliveries will be lower in 21 than pre-pandemic.
And you're acquiring aggressively. Do you develop it all other than expansions?
I've built about one every 3 years. It has to be really special for me to put a shovel in the ground, greenfielding, and deal with local city commissioners and all that jazz. That being said, I've got one project that will C of O in Miami before the end of the year. That's an 8-story, 125,000 foot gross, 85,000 net rentable, right on 395 frontage, going from the airport to the beach. And then I C of O one 2 years ago here in West Palm, and I've got a piece of land under contract to break ground next year sometime. But again, it's all in my backyard. So I think you'll find there's, developers in this space that will continue to do things in their niche. But I love to hear that lenders are pulling back because, there's a lot of cowboys in development. And I think South Carolina is my biggest market that was affected by it. They have somewhat of a Texas mentality. If the bank will give them the money, they'll build it. And they don't care about. Someone forgot to mention that if you build a self-storage facility next to another one, it just cuts the 5-mile radius in half. That they should have just went 5 miles down the road and built another one, instead of doing it right next to one. So I think some of that's been lost in translation on underwriting for some of these guys. And, they left retail or office and they jumped in our space. And so, there's some time to soak up some of this supply. So we need the time. And I think the pandemic ultimately was useful to slow that lending process down, but also speed up the demand that's needed to fill some of the supply. I think we're seeing an incredible amount of activity for the end of this year, just on the leasing side alone. So,
well, if I can editorialize for a moment, I'm a firm believer that there are really only two constraints to development. One is entitlements, zoning and the like, and the other is the availability of financing.
Yep.
If those constraints are not there, then, as you say, I think it's the Wild West everywhere.
Yeah.
In any market.
Yeah.
That developers don't exercise market-based self-control. If the capital's available and they can get it permitted, they're going to go.
Yeah.
We have a couple of questions that I'm going to veer off into. One is you cannot have a transaction panel without addressing cap rates, which Marc did briefly. Can you give us a range for cap rates in major MSAs and secondary markets? Anybody?
Yeah, I'll start. Again, major MSAs, you have to distinguish New York City and Southern California compared to the other major markets, because those would be lower cap rates, generally speaking. We're in some cases, pre-pandemic, we were in the low fours. Again, a lot of the deals that are being done right now are in lease up. So these are projected cap rates. So the going in cap rates could be in, low fours with projected, let's say in year 2 at mid 5s. Those are for major metropolitan areas. And some of those for the secondary markets are getting pretty close to that as well. And we can say this with a lot of conviction based on transactions that we have pending right now. Mike Rogers might have a little bit different take on it, but some of it has to do with the amount of leasing that's in place, the stabilized versus in lease up. So you have to distinguish the cap rate of, are you talking about going in cap rate or maybe cap rate in year 1 and 2?
Go ahead, Mike.
Yeah. So, the way we look at it is stabilized return on cost. That's really how we approach it, because there's just too much variance, too many different ways to look at it, depending on whether it's trailing, pro forma, year 1, year 2. So, and because we are a long-term holder, we just always look at stabilized return on cost. But with respect to the question about secondary versus major MSAs, no question, there's I'd say maybe 50 to anywhere up to 100 basis point spread between the two. Marc accurately stated that New York and Los Angeles are almost in their own separate tier. But when you look at the major markets, it would not be unrealistic to see cap rates around a 5 for the major metros, but leaning more toward the high 5s, 6% range for the secondaries.
When we say cap rates, it requires further definition, and that's my fault. I think that just for purposes of discussion, we're talking about in-place trailing cap rates.
Okay.
Mike, you were talking about going forward yields, which makes perfect sense because that's why you're investing. But when we're going backwards, in-place cap rates, I think you nailed it. Anybody else on this?
Can I add one more point to that, David?
Yeah.
There's one other thing that we didn't mention is that the portfolio premium has certainly started to widen when you start getting multiple assets. Maybe Ben can talk about this a little bit more, but we're seeing this right now. The difference in the cap rates for multiple asset transaction is clearly increasing. I see that continuing to just place a lot of capital at once. There's a premium for that.
The data tells you if you bring something to market that's north of 400 million, you're going to trade at a sub 5, and if you bring something north of $1 billion, you're trading at sub 4.5 on the portfolio trades. I mean, there's pretty clear lines in the sand when you read your appraisals and you suck out all the transactions over the last 7 years. There starts to be a pretty defined marketplace for that. When you're sub 400, sub 300 million in deals, you're in a portfolio transaction, you're seeing trailing at a 5.5 range, and you could be either side of that within 35 to 40 basis points, depending on the markets that you're in. And I think that's a big difference. And so I think there's some clear lines on that. As far as primary assets, and my opinion is just, you're going to see something maybe high 4s to mid 5s, and And if it's a single asset transaction, and I agree with carving out those two very unique markets in New York City and Southern California. But then you're going to see secondaries. We find stuff as wide as 7 still on trailing. You know, and a lot of that has to do with what kind of capital is needed to bring it to what we consider a quality product. You know, and it might just be the office, you know, hasn't been touched in 20 years or 15 years, but the roofs were redone 10 years ago, and they got 10 years left on it. You know, there's a lot of that when you get into this product type and the different types of sellers. It's, it gets tricky with trailing numbers, but everybody looks at it differently. So we underwrite on a 9, yield on cost over a 7 to 10 year hold is really what we're trying to achieve. And
what is the yield you're trying to achieve?
A 9 over a 7 to 10 year hold. And if we apply modest leverage to that, you can find yourself in, mid-teen returns relatively quickly.
All right, Ben, you touched on kind of over-aggressive supply a moment ago with development. We're getting a question from the audience, and this is up for grabs. Does the panel believe that there is a fear of vacant retail spaces converted to storage, negatively impacting supply-demand dynamics? I know that in my travels, I see U-Haul having done this in many places. And, with the retail sector in the throes of major changes, do we see this as a threat in terms of providing excess supply in various markets?
Well, David, I touched on it before in some of my opening comments. I definitely think that that's a threat, and I think it would come, in my opinion. I mean, there is going to be a lot of retail and other space that needs to be repurposed. I think it's incumbent upon, the zoning and local officials to make sure that they don't cannibalize their own markets. And I don't know that that's a healthy strategy, but I will tell you that I think that there's definitely the potential for partnerships. As you see very sophisticated people like Blackstone coming into the market, they have tremendous reach across their portfolios. And when they start to put pieces together, maybe a retailer that they have a significant investment in that has a lot of dark space around the country, I could definitely see a situation where they try to get strategic about that. But equally, that's going to be balanced by how much demand is there really in the market. I think you're going to see very sophisticated people like that aren't going to necessarily build in areas where they don't think that there's demand. But on the flip side, they certainly have the patient capital to be able to endure the lease up. And we all know self-storage is a long play. And so, they're not coming into the market casually. I guarantee you they're looking to grow their presence here. And, I think that would definitely be something that I would be concerned about.
I personally don't find it as a fear. I just think, each deal's going to be different. It depends on what side of the trade you're on. Obviously, if you're already in that market and someone can pick up something, well below replacement cost. I've converted over 8 different low cost deals out of the downturn last time. And, some markets, you just can't buy it cheap enough to convert it to self-storage because the lease up takes a while. And I think, I've tried to convert several retail properties, had success on some, and some you wouldn't dream of getting the commission on board or staff on board to do something with that space besides an active moving. We don't have the best reputation for creating walkable activity around our spaces, which has driven some of that, unfortunate forced retail, as I would call it. We have some vacant spaces that sit below our buildings in a couple markets that just won't ever lease up. Over time, the staff forgets about it when there's a regime change. And I've went back 7 years later and just filed for a permit and converted it to self-storage and got zoning approval and stamped permit plan. So, it's a long functionality around this game. So, the idea that this will just, snap a finger is not a concern. I think it gets to bigger macro issues like, hey, let a bunch of people in, fix immigration, and you won't have to worry about any of this. So I just sort of laugh about some of the concerns around it, but I think it is a risk out there, but it's not a fear. It's just more market share. That's my opinion on it.
All righty. Well, I'd like to thank all of you fine gentlemen for participating today. Our time has come to a close. I really, really appreciate your perspectives and participation. Up next, I'm told we have our first round of breakout sessions starting at 12:15 p.m., which means they're started already. Use the left-hand navigation button to choose which session you'd like to attend. And for now, I'd like to thank you all again, and we'll do it again soon.
Thank you, David.
Thank you.
Gentlemen.
Cheers.
Bye.